Okay, awesome. See, I got you as the battle of the market wizards. Even though I know you're not really battling, you're running two very, very different approaches.
But we're drinking our coffee.
You're drinking our coffee. Exactly. Tom is a real trooper. He's also coming to us from Arizona. It's super early for him, and he's known as Mr. Serenity because he's obviously figured out a way to trade the market without having any emotional ups and downs. Jason and I are, on the end, I think, a little bit more emotional human beings, right? Jason is the first one to admit that it's never as easy as it looks. But gentlemen, welcome. Thank you so much for joining us. Of course, let me just sort of give you a little bit of an introduction of both gentlemen, which is that Jason is a contrarian. Basically, Jason's approach to the market is to trade positioning. Jason believes very, very strongly that the key to making money in the market is sort of like that quote I told you a little bit in the other panel from a Citibank trader whose name I forget, who said, "It's not enough to be correct on your investment thesis. Everybody else has to be wrong." And I think that probably encapsulates a lot of Jason's methodology. He looks for ideas where as many people as possible can be wrong, which creates, obviously, the reverse opportunity in the markets. Whereas Tom has a completely different approach, which is to go with the flow. And both of these gentlemen have been in the game for many, many years, for decades. So it's not like one works and the other one doesn't. They both work if you apply them specifically, and that's going to be the key that we're going to be talking about. But Tom has a very, very different approach, which is that I'm going to spread my bets across 50. Last time I talked to him was probably about 50 different algorithmic systems, and most of them are going to be trend based. Some of them will be mean reversion, but I'm going to mix and match. And the idea here is to create a very, very robust portfolio, not necessarily a single trade idea, not necessarily a single investment thesis idea, but that when all these pieces come together, they're actually going to provide a very attractive return for me, which is kind of an interesting approach. And Tom, by the way, was we were talking earlier, was sort of the first manager to mix commodities and stocks together. And he was telling me earlier that at the time that this was unheard of, and people didn't even want to give him money because it's two different markets, two different margins, two different rule sets, which is sounds ridiculous now when we're all sitting here trading every single item either in an ETF format or a CFD format or a futures format. But it just goes to show you how basically times change, and if you're sort of ahead of the times, sometimes it helps, and I guess sometimes you're just ahead of the times, right? And you have to wait up for the market to catch up with you.
A lot of wasted effort for no gain whatsoever. One of the reasons I retired at the time.
Exactly.
It didn't seem like anybody could understand simple math and statistics, and so finally I said, well, I don't need this anymore. I'll just go manage my own portfolio, and to heck with the clients, and my life's gotten a lot easier.
Exactly. By the way, I'm sorry, I don't think you guys have actually met. So Jason, this is Tom. Tom, this is Jason. Just want to introduce you guys.
Hi, Jason.
Great to meet you, Tom.
Yeah.
Hi.
I have to say that I've been called a lot of things. Mr. Serenity has never been one.
Yeah, I know Jason a little bit, and I know definitely Mr. Serenity is not his middle name. Neither is it mine, by the way. So I kind of wanted to ask first a conversation away from the markets. Just sort of, it's a softball question, and I know both of you guys are going to say, but I'm just curious. You've had a lot of attention thrown your way because you both were featured in Market Wizard books. Market Wizard books, for those of you who are not, only new traders don't know what Market Wizard books are. Those are the most popular books on trading. There are a bunch of interviews with a whole bunch of traders. We've had, of course, the great Linda Raschke here with us a couple of times. The point being is that there are, very few people in the world that were featured in these books because they had really interesting, unique stories. They had really interesting, unique performances. And I'm just wondering, has this had any impact on you? Knowing both your personalities, I know you're going to say no, but I'm just curious, Tom, what has been, since you were featured in the book, has this changed anything in your life? What happens now that you're a market wizard?
It probably, back in the late 90s, right about the time at 95, I moved the company Trendstat down to Scottsdale, Arizona from St. Louis.
Mm-hmm.
Right about then was when New Market Wizards came out, and I was probably a larger known name at that point. Before that, it was a bit more, the business was coming in. We were, growing. I obviously did well enough to, pull off an entire move of a company. That was $250,000 expenditure right there. So we were doing all right, but I think it sort of sped things up when it came out.
Nice.
And that was
welcome, right? Welcome news, I guess.
Yeah, it was okay. And we kept up with it. I would say it probably made my life a little bit busier, a little more travel, a little more visitors to the office and all that. And then it kind of, at that point, I think, as we came into the 2000s, I really started analyzing the business, the software we were running, my own life. And I said, I don't need this anymore. So in 2003, I closed it all down. I've been managing my own money since.
Right.
And it's so much easier. Oh my gosh.
Right.
The amount of complexity of dealing with hundreds of clients in lots and lots of different countries across lots of trading desks. We had 40 computers for 10 people. We had data coming in, data going out. It was information processing juggernaut. And
now, you were trading 24 hours a day. You were trading Asia. You were trading like the Singapore exchange topics, like everything, right?
We were trading a lot of things. Yeah. There was, you got to have backups for everything. You got to have backups in people, backups in equipment, backups in power, backups, ways of getting to the internet. Yeah. It's an information processing business. And for me, that's the way I ran it. I'm sure you guys that are more traditional traders have a different approach to everything. But for me to keep operating and to deal with the liability that you have as a money manager, you got to have backups and you got to have everything running. And so there was that constant, I could tell what I would be doing every day by the clock. Because it's sort of the same thing. Information comes in here, it goes out there, and the time of day is the same. And the people
I can see how it could turn into a real grind. Absolutely. Now, Jason, on the other hand, you have kind of dove into a little bit of your wizard fame because you decided you're going to open up a newsletter. You run a very, very good newsletter called Crowded Market Report. But that is a two-edged sword, man. I see the abuse on Twitter, and I'm just wondering, like, do you just like, hey, I shake it off, or does it annoy? Because we're all wrong all the time. I mean, that's not even a question. But every troll on Twitter loves to rub your nose into if you just if you're off by a millimeter on a position. I'm just wondering, how do you deal with that as a dynamic of our life these days?
Oh, that doesn't bother me one bit.
No,
we do what we do. I mean, without sounding like too much of a jerk, the people who have followed the advice of our newsletter have made a lot of money. I never once claim. In fact, I do the opposite of claiming that I am right all the time. Yeah, I'm happy to admit that I am right less than half the time. Right, and that's actually part of what I am trying to show people. Right. In the newsletter and trying to educate people about what trading really is. That is not what it's about, right? Trading is about making a bunch of money when you are right and losing a little bit of money when you are wrong. Right. And that's what this game is, no matter what anybody wants to tell you. And anybody, you can see Tom nodding his head, anybody who's actually had real success over time in doing this will tell you exactly that.
Jason, I think my stats would be about 33% of the time right. Exactly. Over my lifetime, that's 5 decades.
Exactly, and mine are over the 20.
I think it was 36, Tom. Last time you were on the show, you said to me you were like 30. According to your data, you were like 36% accurate, but when you hit them, it was like a 4.5
Oh yeah, well, it depends on the strategy and the markets and lots of. I mean, but
yeah, is that correct, Jason? Sorry, I didn't mean to talk over you.
That's where I am. I mean, that's right where I am over now 20, almost 24 years of running this process that I run. We're at 38% winners, and the average is about 4.5 to 1, the winners to losers, and that's what trading is. People want to make it into something else. It's not about predicting the future. Okay, Nostradamus is a myth. Nobody predicts the future. You know, I love listening to interviews by Druckenmiller, who's arguably the greatest money manager of our time. He says it all the time. He's wrong all the time. All the time. Okay. It doesn't matter. So when people on Twitter want to troll me, I love it. I laugh. I'm like, okay, so you don't understand anything about trading. So that's great. You know, I don't even say that. I just laugh. You know, I usually say thank you to them is what I say.
I think the funny thing about Stanley Druckenmiller that everybody trolls him on is like if you followed him for a long time, you kind of understand this. You know, Stanley Druckenmiller will have a very, very confident view, weekly held, meaning by that weekly, WEA, weekly held, meaning that he'll be like, oh, I'm like 100% long bonds. And then you talk to him like a week later, oh, I shorted bonds like it was no yesterday. And people don't understand that, you know, he will change his mind on a dime, which is why he's so good. But people go, oh, look at him. He was long bonds. He was completely wrong. But that's not how it works. You have to have a very flexible mind. But, you know,
I have a client who had money with Stanley Druckenmiller when he managed money for other people. And he told me that Stanley would write these monthly reports. And Stanley's a very smart guy and a very articulate guy. And he said the monthly reports would just be the most beautifully written things that you'd ever seen. And the arguments that he was making just seemed so right and so logical. And they would be totally wrong. And then the guy would get his account statement and he made money again that month.
Right.
So
no, that's true.
Be wrong, make money. You know, that's the best thing, right? Exactly. And I think that that's the biggest personality flaw that most people, one of the reasons most people fail at this is because they don't want to be wrong. You know,
one of my favorite sayings that even my wife quotes me now. Sometimes when we're watching Varney in the morning or something like that, and watching how the market's open, and Stuart will say something about, what do you think the market's going to do by year end or something like that. And my wife will say, the market will do what the market will do. And I keep saying that over and over again. I mean, like it was stocks Friday. I'm looking at all the red on the indexes. So people are asking me, well, is it going to crash by the end of the year or whatever? Or are we going to, is this buy the dip opportunity? The market will do what the market will do. I'm ready to go either way. Right now, I'm probably net short, I guess, 5 out of the 6 indexes that I trade. Monday, I might end up long.
Yeah, I was going to say that's so interesting because I remember you posting like a week ago, and Tom, by the way, posts a lot of his positionality all the time on his Twitter. Really, really great Twitter handle at Basso_Tom. Go ahead, follow him. So, and Jason, of course, posts an amazing. Jason is like really my go-to guy, period, on Twitter as far as where you want to know where things are. But Tom, it's funny you were talking about that. I used to work for a Bear Stearns broker when I was like in college, and he used to always go, Mr. Jones, the market is going to go up or down unless it stays the same. And that was a classic refrain. From him. It's sort of like
my friends used to call me up. They don't anymore. But my friends would go, hey man, what's the stock market going to do? I'm like, I have no freaking idea. Yeah. And they'd be like, what do you mean you have no idea? You're a hedge fund manager. I'm like, I'm a hedge fund manager because I have no idea. Okay? Right. It's very hard to understand that concept, but that's fact.
Exactly. Yeah. Speaking of that, by the way, there's a question here from Charlie that was kind of good. He's asking, can you please tell us the risk management system used by hedge funders and large traders? Maybe you guys could talk a little bit about the kind of risk management systems you yourselves have implemented over time, maybe how they've been refined. I'll let Tom start because he's got a lot of.
Yeah. All right. Well, let's see. Risk management systems. The first thing I would always try to put in place is some point at which you say this trade's done, so stop loss of some sort. Right. So that sets the amount of dollar loss that you'll end up suffering roughly. And that's a critical thing to start with. The other thing that I find is very effective in my own case is to position size based on the amount of risk that you're taking and the volatility that is currently in the market. So in other words, if you've got a market that's twice as volatile, to make the math simple, I would size it at half the size that I normally would if the markets were just quiet. And so what psychologically that does for you is when a market's quiet, you start building bigger and bigger positions, and then they break out and everybody knows about the move now. It's Coco going to the sky, like an F-35 taking off, straight up in the air. And you're in on it with a bigger position. And then as the market becomes more volatile, as everybody finds out about it, I back the position off to keep that portfolio balanced perfectly.
Now, can I just interrupt you here for a second to really refine this point so people can understand it a little bit? Because I'm trying to understand the volatility process here. Do you mean, let's say volatility goes twice as large, and we'll use Coco as an example. If volatility is low, you're risking 1%. If it gets twice as large, you're going to risk maybe 0.5%, or do you risk the same 1% and make larger stops? Like, in other words, if your stop is 100, now the stop's going to be 200. In other words, do you risk the same size of a dollar and widen your stops, or you actually do smaller dollar sizes? I
do two. I start with the price action, and I set my stops according to the price action. And if the market's volatile, those stops are going to end up being a little farther away. So as a one contract, if you're looking at one share or one contract, depending on whether you're trading stocks or futures or whatever, even FX, we would base it on 1 million FX. Whatever it is, that's the dollar per unit. So then the question is how many units can I buy?
I see.
And I do it sequentially that way, not the other way around. I don't set my stops based on what my risk needs to be, because the market's not going to respect that at all. I may be putting my stop right in the middle of the noise, and I'll be taken out tomorrow. So I first set the stop, and then in a case like Coco, good example, it's going so fast, my poor stops can't keep up. I mean, no matter what math I use, there's no way anything that I could dream up, unless you do even a parabolic stop. The math there is still not going to be able to keep up with what I saw out of Coco this last week. So what you do is your risk per contract or per unit is getting higher and higher and higher, because you can't get the stop to keep up. Well, then I ask myself, all right, how much of my equity is now at risk in Coco? And I just simply set a limit. I say, okay, I don't want more than 1% risk in any market, Coco or anything. So I'm at 1.1. I need to peel off one contract or two contracts or whatever the number is to get back down to my allowable level. And that way I'm Mr. Serenity. I've got lots of different positions, all with their max limit on equity. It's kind of like, I like to think of it as like I'm one of those guys. If you ever see some movies about casinos, that they have that central control booth up there with one-way windows looking out over all these slot machines and poker tables, and this lady over here just hit the jackpot, and you're paying out her, but you're bringing in money from all these other people, and when you add it all up, the casino makes money every day. And that's kind of a little bit more of the mentality that I like to have. I don't mind having a lot of different positions across a lot of different strategies. And I'm just looking to try to make the daily total go green. And so it's a numbers crunching task.
Got it. Well, Jason, what about you in terms of your methodology on risk? Is it just straight up? Do you vary it with volatility? How do you approach risk on a management basis?
So I think, to Tom's point, It's going to depend on what your trading strategy is. But here's my trading strategy. This is why I got in. Okay. Yeah. This is where that trade is wrong. It's not about some money management stop. Like you could sit here and trade S&Ps and be, oh, well, I only have a 0.5 point stop on my trade, so I could trade 5,000 S&Ps. Yeah, but you're going to get stopped all day, right? 0.5 point, right? So it's not about that, right? It's about this is where my trade is wrong. So therefore, this is where I'm going to stop. Okay, so we know that now. We know where we're getting in. We know where our stop is because the trade is wrong at that point, right?
Okay.
And then, yeah, you back into how much you're willing to risk on a trade, which for me is the same on every trade. I risk 70 basis points per trade just because I have found through back testing and now through 20 whatever years of live testing, that gets me to the portfolio volatility of about 7 to 8, which is where I want to be. Okay. Based on my trading style, 70 basis point risk per trade gets me to that volatility.
Right.
So that's what I risk. So I know I'm risking 70 basis points of my assets on this trade. I know where I'm entering. I know where I'm getting stopped. How much do I have to put on? So if I'm wrong, I lose 70 basis points of my that's it. And that's, I think that's an important point. The point of where you're going to get stopped, which Tom brought up, is so important, right? Right. And again, it's going to depend on what you're doing. If he's trend following, then he's probably running the trailing stop. Because I'm turn picking, I'm not doing that, but that doesn't really matter, right? The whole point is, where is the trade wrong?
Exactly.
That's where I'm getting stopped. That's it. And therefore, I'll size to that. And now he's going to have to dynamically adjust his sizing because he's trend following so that, like he says, the volatility is expanding, right? And he only wants to risk this, so he's going to dynamically adjust his sizing, as he talked about. My stuff won't do that because of what I do, but again, it doesn't matter, you know.
But on the other hand, when volatility is contracting, he's also going to be adding size, which is, will work if it goes his way. It's going to work for him. He's much more fluid and dynamic. Which brings me to
and I also have, like you said, 70 basis points. I do 50 basis points for a new position, and then a 1% of equity for an existing position, which by definition would have been a very big profit runner already.
Right.
And because I picked up another 0.5% of risk, probably that market's been really going my way. I cap it at 1%, but I started it at 0.5%. So I'm even more conservative than you when I put that position.
That's super important. And this is something that, quite frankly, I still struggle with because it's like to say, I started my risk at this, but mark to market every day. If God forbid the trade's actually working, well, now I'm in the money. And so now my risk mark to market is more. So what am I supposed to do? This is something I struggle with all the time. And of course, you struggle with it every time you have a winning trade that then turns around into a loser. Now you're like, oh, I should have been taking some off the table, during it. I go through that still.
This is such an important point, and like I really want to zero in on this because many people don't understand it. If you guys could explain it a little bit more, what you're sort of saying is, you started at like 70 basis point risk. Then the trade is maybe 2 times, at 2x profit. Now it's like 140 basis points in the good, in your favor. And actually, now your risk is actually 140 plus 70. It's actually like a bigger risk to the stop out than when you started. And you're like, oh my God, what should I be doing now? And this is where it gets so hard because you either have to commit all the way to the terminal exit point, or you start screwing around with it. And then obviously your long-term averages really start to get messed up because of that. Your statistics get messed up. Is that I'm interpreting?
Well, Boris, I would give you this advice there, mathematically speaking, because I've done these studies. If your goal is to make as much money as possible, so return is your goal, you probably want to hold on for dear life and let that position run like crazy. Jerry Parker and others would argue statistically and correctly, I believe mathematically, that you just hold on for dear life and you have to have a stomach for it. And a lot of traders do not have that stomach. If you want to maximize,
and that's what Jason does. That's why he's never Mr. Serenity, because it's really hard.
Well, and what my objective is a high return to risk. So I'm a retired guy. I'm managing my own money. I like playing golf and, pruning my bushes in the yard and everything. I like to get away from the computer. So return to risk is my what I'm trying to maximize. And if you're trying to maximize return to risk, you have to think through the math of that. Okay, so you got the return in the numerator and you got the risk down here in the denominator. And the denominator has a big mathematical effect. So those drawdowns start the day of your equity high. The day of. That's the way. I mean, I was a money manager, and these allocators would nail you with that top day of the equity run. So my attitude is
shaking his head.
keep your
allocators.
Keep your risk managed by peeling off positions if you have to maintain a very, very balanced, very, very controlled risk environment in your portfolio. And when I wrote the book, Successful Traders Size Their Positions, the math that I've used for 45 years is right in the book. So, Jason, you don't need to struggle anymore with whether or not to peel a position up. All you got to do is set up a spreadsheet, and it'll put the math in there, and it'll tell you where you should be to maintain a balance, if that's what your goal is.
I appreciate that. I mean, I think the comment is so important, and I talk about this quite a bit. It depends what your goal is. Just
exactly.
Like you said, right? And I always say, you say it to someone. It reminds me when I started playing guitar, right, a few years ago, and the teacher would be like, "Well, what's your goal?" I'm like, "What do you mean? What's my goal? I want to be Jimi Hendrix." I didn't even understand the question, right? Did you ask somebody that starts trading, "What's your goal?" "What do you mean? What's my goal? I want to make a ton of money," right? That's my goal, and that's the answer you're going to come up with. Just like my answer was, I want to play like Jimi Hendrix. As I've played guitar for a few years now, I get the question. It depends what your goal is to determine how you're going to handle this stuff. If your goal is serenity, then you're going to want to put less risk on. With my thing, I have another issue there, in that I am also trying to maximize return to risk, but because of the way my business is, okay, I have a business, clearly, because people love to deal with handsome people. But other than that, okay, I have a bit. If I were a trend follower, I wouldn't manage any money. I work alone. I work out of my house. None of these allocators are giving me money as a trend follower. I have a business because I'm a counter trend trader. I'm a turn picker. So the return stream ends up being negatively correlated to other return streams, right? That's my business, right? Now I have to make money and I want my risk. So I'm maximizing for return to risk with the added thing of I need to have zero to negative correlation to these other things as well. So I have to take that into account as well. That's my business, right? Yeah, that whole issue of open trade, and the key to it is I've been able to back test to find where the best place is, what the best thing to do is, and B, now I've got over 2 decades of actual testing, right? That I go through at the end of every 6 months and look and monitor and make sure that, so that's what gives you the confidence to do whatever it is you're trying to do. Hopefully it doesn't guarantee, as they say, the past doesn't guarantee the future, but it's something, right? So those are the key things rather than guessing, testing, checking, keeping these statistics on your own trading, keeping a journal. Hey, on this one, I got out of half. On this one, I didn't get out of half, and 2 trades aren't going to matter. But over time, as you have 100 trades, 200 trades, you can start to determine, hey, what would have been better over time? As an example to what I'm talking about, what I have found is, so if I'm buying something at this turn because I see the market is super crowded short and I'm getting long, okay, I get long. Hopefully the market goes up on my winning trades. The market goes up. I get out when that crowdedness is no longer there. Okay, because that's my edge. The edge is it's super crowded. When it's not crowded, I'm out. What I have found through testing is what would give me more P&L is if I just stayed long that thing until I got all the way crowded long. And then I got out and started getting short. That would give me better P&L. But from the point where they go neutral to the point where they get super long, my volatility goes way up, right? So it's not worth that extra unit of return per risk from the risk return point of view. And then, of course, if they're super short and now they're getting long, that is the trend followers, obviously, for the most part, getting long. Those are the people I don't want to be correlated to. So I want to get out when they're getting in, right? So I always say it like I've done my job at that point, and now it's their job, right? I don't think I have nothing against trend following. I think trend following is a valid strategy that's valid in people's portfolios, right? But my clients, for example, are mostly fund of funds that have trend followers in there, and they need something to offset that trend following, right? So I do my job. I catch the turn, and then the trend followers are coming. Okay, now they do their job. Like that's what having a balanced portfolio is all about, right? So, okay, maybe I could make more money over time if I held it the whole way, but that's not my job. So, and that's not what I do, and that's not what I'm optimizing for. I'm optimizing for risk-adjusted returns as well as this correlation thing. So again, it depends what you're trying to do.
Exactly. There's a million different people trading, and there's a million different ways you could try to make money in the markets.
And also a million different ways, agendas, because like in a way, Jason's is not, like he was saying, it's not a maximizing agenda because he's got other considerations that he must take into account because he needs to be negatively correlated. Now, speaking of trades, by the way, this is what I'm interested in. Tom, how many trades a year do you do? You obviously, you guys all keep statistics. Just a round number.
Oh gosh, at this point with like 7 different strategies and any one day I've got hundreds of positions.
Right. So more than 5,000. Just
well, let's see. I could probably let me do this. There's about 250 trading days a year, right?
Right.
And let's say 25. How about somewhere between 6,000 and 7,000 trades a year, probably?
Yeah. So your brokers love you. My point here is the man versus machine conversation. Is Jason probably does 10 basis points of that. Like I don't know. I don't want to speak for you, Jason. How many trades a year do you do generally?
Probably about as many as Tom does in a day.
I was like, for a second you had me there. You had me because you told me you do 6,000. There's no way you can do 6,000 trades. Yeah, no.
But I mean, again, remember what I'm doing. I'm picking. Ultimately, I'm picking market turns. How often does the market turn? A market, and I'm not intraday turns. I'm picking, big market turns, right?
Yeah. So,
how often does that happen?
It doesn't happen that often.
Right. So therefore, you know what I mean? I'm not trying to do it too often, but I do I think this year, somewhere 35 to 40 trades, I think I've done.
Right. So that brings me to my point about knowing what it is that you do and how you do it. It's physically impossible to do what Tom does. I mean, maybe not, but you really have to be a complete, market junkie to do what Tom does non-algorithmically. You can't do 6,000 trades, a year. Maybe I could do it because I'm just an inveterate, degenerate trader, right? I do 100 round turns a day, but that's not the point. The point is that's impossible. That is why Tom's approach has to be algorithmic, whereas yours does not. 35 trades is not an extraordinary amount of round turns. It can be done discretionarily. That's my point, I guess. Would you guys agree with that?
Yeah, I would. Any one particular market and any one particular strategy, I could sit here and run it manually myself without any issues at all. And I've got enough experience that it wouldn't stress me out or anything. But trying to do it across, 38 markets with 7 different strategies and different time periods, and some of them are counter trend and some of them are trend following. My brain would just be fried if I could even pull that off. I dare say I don't think I could.
You would not be Mr. Serenity. You would not be Mr. Serenity. That's exactly
no, I'd be exhausted too. I mean, I wouldn't have time to go out and work out or prune my bushes or anything like that. It would be pretty much all day, long day. Oof, I wouldn't even want to envision that. Thank God for computers.
Let me just go back to what you said a few sentences ago. In order to do something like that, you would have to be a market junkie. First of all, I will argue that if you plan to make money doing this particular thing, you better be a market junkie. Okay, this is extremely. People don't want to understand it. Extremely difficult. Okay, this is one of the most difficult things, not physically, mentally, psychologically to do in the world. Okay. I'm not saying it's more difficult than being a fireman and going into burning homes and saving people's lives. But from a sitting, here working thing, it's one of the most difficult things you can ever do. And the success rate is very low. So while Tom might be out there trimming his hedges and doing whatever, trust me, and this is the first time I've ever met the man, he's a market junkie. He doesn't need to be doing this. He loves doing it. He's got plenty of money. He had a very successful career. He could put his money into
treasury bills. Yeah.
You know what I mean? And go live the rest of his happy life and trim his bushes all day. You know what I mean? But he loves it. He's a market junkie. It's a game and you love it, right? And if that's not the case, okay, it's a puzzle, right?
It's a puzzle.
And you want to solve it, right?
And I never will.
No, and that's just it. It's a puzzle that you want to solve and you're never going to solve it.
Exactly.
But you're hoping to get closer each day, right?
It's like golf. You never shoot a perfect round of golf. You only get slightly better at it over time.
I think
if that's not your approach, and if that's not your thought process to this, I'm telling you do something else.
It's so interesting you say that, Tom, because my dad is just a golf fanatic, and I couldn't care less about the game, but I have to endure every single hole, every single description. And the man is 87. He shot in 82, so he beats his age, which is
nice.
Props to him. But it's interesting that you say that, because his obsession with golf is like my obsession with the market. Like that is I just realized it as you were saying it. Like it's literally the same compulsive obsession in a way. It's very true. It's just that we absolutely focus on the market, whereas like you said, golf is the same kind of all-consuming passion when people get into it.
I'm sitting there with 7 strategies in different time periods and wondering what's my 8th strategy going to look like. I'm always thinking about when I'm out pruning the bushes, or hitting golf balls, I'm thinking in the back of my head, what am I missing? What could I add to this to reinforce those periods that I'm not capturing very well mathematically? What type of market action is going to really be my Achilles heel? And how can I do something to protect that and exploit it maybe?
Oh, totally.
I'm always thinking
after 40 whatever years of doing this. That's
50. 50. I'm older than you, Jason.
That's still what he's thinking about.
Yeah, it is. So speaking of, what do you think about it, Jason? Just could you run us quickly maybe what your day is like? What do you do? On a regular day. To kind of get to the point where you need to be in terms of trading.
What I should do or what I actually do?
Yeah.
What you actually do.
What I actually do is I sit in front of this freaking screen 18 hours. Right. That's what I actually do.
Right.
And I don't need to, and I probably shouldn't, right? Because I put my trades on. I don't trade very much, and they're going to do what they're going to do. I know where my stop is.
Right.
You know what I mean? My process is going to tell me where my exit is, and I don't really have anything to do, and I shouldn't. But that's not what I do. I sit here and I watch. But one of the things, what I'm really watching, I believe most of the time, is really the correlations between assets over time.
Mm-hmm.
You can do things like value at risk, for this is all portfolio risk stuff. We've talked about individual trade risk, but then clearly you have a portfolio risk as well. I can say, I'm risking 70 basis points. I'm long the S&P, and if it takes out this level, I'm gonna lose 70 basis points. But if I'm long the S&P, the NASDAQ, the Russell, and the Dow, and I'm risking 70 basis points, then I'm not risking 70 basis points.
No, right? It's
180 basis points, right?
It reminds me of a guy one time who came up to me. He goes, "Listen, I'm totally diversified. I'm long dollar yen, pound yen, euro yen, and Aussie yen."
So that's what I mean. So so there's that portfolio risk aspect to it, and portfolio risk, what it really is the correlation between the assets that you have, right? And those are ever changing, right? You can run. They have the value at risk programs that will theoretically do that, but I have found those to be horrible. Mm-hmm. They work 85% of the time, and they don't work the 15% of the time that you need them to work, right? That's the story, and that's exactly what happens. So therefore, I think I can do a better job of that. At least, I don't know if that's true, but I like to believe it. And that's how I justify why I sit here all these hours, because I am watching the correlations between these markets, right? so it can help me. This is where I do have some discretion in my portfolio, is I may change the size of various positions based on what the correlation between the positions that I have on are. If I think that they're getting very correlated, then I will probably reduce the size of those positions by a little bit, knowing that my risk is higher than what I think it is, right?
Right.
So that's really
That's
what
something you can pick up in real time. That's why none of these all these correlation studies always tell you about they cannot pick that in real time unless you're just watching it constantly and seeing the change in behavior.
Right. So that's what I do. And you know, fortunately, I would say for me, you were asking before about did the market wizards change anything? It didn't change anything in my business, because by the time Market Wizards came out, I was managing all the money that I wanted to, you know, I haven't taken new clients on for like 6 years, right? I wasn't looking for new clients or anything like that. But because of the Market Wizards, we started this thing that has this Discord page. And so I'm on that Discord page all day talking to these people, which has been just it's something I didn't know. I didn't even start, you know, someone else started this thing, proposed it to me, and I was like, yeah, let's go. I didn't even know what Discord was, you know what I mean? But you know, I'm on the Discord, and we have had some incredibly interesting people on there. Some really good and some interesting stuff, and people that are looking at stuff. And so I'm on there learning, quite frankly, from some of these people. You know, the goal is to try and teach people, and I like to think that I am doing some of that. I don't know everything. I can only teach them what I know. But then all of a sudden you get a community of a lot of people, and they know other things, and I'm sitting there most of the day talking to them, and you know, we have some fun on there too. You know, we put some music on, you know, all that kind of stuff.
Nice. Like you know, it's definitely a lot more fun to trade with other people. It can be a very lonely game if you don't have some community.
Yeah, so that's what most of my day is. Now around that, I do try and my day has always been about, because I first started trading in Hong Kong when I was in my early 20s. I was living in Hong Kong, and that was where I first started trading. My internal clock to this day, I wake up every night on the Hong Kong close. Okay.
Which is like,
I don't even trade Hong Kong anymore. Right?
Is it 3 a.m.? What is it?
4 a.m. 4 a.m.
4 a.m. Okay.
I wake up every day on the.
I'm there with you. We can text each other. I'm there with you.
I get up, I check, I look what's going on, right? And because of that, the market closes at 4 o'clock. By 4:30, I'm asleep.
Yeah.
Right. And I'll sleep from 4:30 to 7 or something like that.
Right.
And then I'm up usually 7 till about midnight. Midnight, I'll go to sleep. 4 o'clock, I'll wake up for half an hour, and then I'll go back to sleep 4:30 till like, you know, 7 a.m. when my wife gets up to go to work.
Nice.
That's kind of my day. And within that, I'm always struggling to get away from the screen, and because I'll just sit there and be like, look, there's nothing every day. There's nothing I can do here. The thing's either going to go up or down, whatever. So I'll go over there, and you know, I'll play some guitar. You know, I try to get away. I try to play some guitar.
Nice. And I know, Tom, you have a much more methodical approach where you do a certain amount of time in the morning, and then you go do lots of your own activities, right?
Yeah, it takes me about 10 to 15 minutes to check everything that's happened overnight. And usually there's somewhere between 10 to 20 trades that have already occurred overnight. And so I just adjust spreadsheets, make sure that I've kept track of everything, make sure I didn't make any mistakes or my software didn't make any mistakes, that type of thing. And then it's pretty much take care of other things, do an interview here and there, do, just put away the snail mail in the files, do some computer maintenance, upgrade software, go out in the yard and do some things. We're trying to consider doing a hot tub. So I'm measuring with flags in the yard, trying to figure out where exactly this thing's going to sit and how are we going to build a pad for it and everything else. So a job like that, I might be outside, get a little sun and fresh air for an hour.
Right.
Then I come back in after lunch, of course, Arizona time. So we're a lot earlier than you guys in the big cities over east. I'll have about a 40-minute to 45-minute, something like that, process. I call it the afternoon process, that data is available. I'm now applying all my algorithms to it. some of it's more automated than other parts. Some of it's more spreadsheets that I've got to update. Others parts of it is just completely automated. It generates the orders. I review them, transmit them individually, and I'm transmitting a good 100 orders or more. So it does take a little time, but I've got a graph over here and the transmit button over here, and I'm just going, yeah, that looks good. That looks good. That looks good. And it's pretty fast and straightforward, and it doesn't strain my brain too much. And then I'm done. I close down the computers and.
So when you're bleeding, let's say you're 15% off equity highs. Does it get harder to transmit those orders? Like, is it like, these bastards better be right this time? Do you have that?
Not after 50 years of doing it. Yeah. I have been through so many drawdowns, I can't even remember how many. And I just had a 10% drawdown right through the election. It got really bloody overnight there.
Yeah. I remember you were long, and then it whipsawed you out. No, you got short, and then it got long again, so it totally whipsawed you out.
And now I've ripped off about 6 days in a row of the biggest profits that I've seen in a long time, going back to maybe COVID rallies or COVID crashes. That was probably even faster, but we've had some really, really good days the last 6 days, and I'm almost at equity high again. So, when I'm in a drawdown, I'm mentally remembering those periods when I was at equity highs. And when I'm at equity highs, I'm kind of remembering those times when I was in severe drawdowns. And what it does is just kind of keeps you nice and flat.
Right.
And maybe that just comes with having lived 50 years in the business and trading, and you've kind of seen it all, and you sort of it's another day in the funny farm, so to speak. You don't get high or low as much as just sort of watch Tom trade. It's like you're detached from it all. It's just what I do every day, and then I go on and do other things.
Right.
I think something that a lot of people do, they label themselves a trader. And I think it'd be more mentally balancing to view yourself as a person who does a lot of things, one of which is trading. So, I'm kind of a landscaper. I'm a golfer. I cooked dinner last night. It was really delicious. I make wine during the summer up in the mountains. I do a lot of things.
Unfortunately, you're talking to Jason and I, who, aside from maybe cooking and guitar, which is one of my things, have no life whatsoever. So it's falling.
You guys got to come out. You guys got to come out west and enjoy your life.
I don't cook. It's such a great attitude that Tom just expressed. Yeah. When I'm having my equity drawdowns, I'm remembering when times when I'm at highs and when I'm not. It's such a great attitude. I wish I could have. To me, when I'm having a drawdown, what I'm thinking is, okay, this is it. Game over. This is going to be the one that I blow out. And when I'm making money, I'm thinking, I'm about to have a freaking draw. Like I'm just a miserable bastard. So, I was just talking to a friend of mine about this just last night. We were having this conversation how that's for a lot of people, especially miserable bastards like me. That's how it is, man. There's no happiness in this game because you can't rest. As soon as you're making money, all I'm ever thinking about is that just means I'm going to be losing money soon. I get to the end of the year. And I haven't had a down year in quite a long time. But somehow I get to the end of the year, and that's when I get paid. And my clients will send me a check, and I'll be like, "Oh, this is great." I don't think I remember having one winning trade this year. All I remember is losing trades, and I got stopped on this and that and the other thing. How the hell did I make money this year? I don't even know. I don't remember having any winning trades over the course of the year. I remember, oh my God, this one, and my stop was here, and it gapped through my stop, and I got this huge slippage on this trade. How the hell? You know what I mean? Like those are the things that I think happened here, but somehow I don't even know how. Somehow here it is. I'm getting paid a check because I made money this year. So Tom's attitude is clearly much healthier than mine. But what can I do? I'm just a miserable bastard.
Yeah. Well, as miserable a bastard as you are, we'd still love to pick your brain, because the last question I have for both of you, and we'll start with Jason, is just let's talk markets, because Jason's got the best intelligence in the world, in my opinion, even though he's going to totally poo-poo it. Where are things standing? I mean, I'll tell you how wrong I've been calling the top for the last year and a half. I've been wrong. Fortunately, I don't trade my opinion. Thank God. I've learned not to do that. But generally, let's just go through the big ones. S&P, NASDAQ. Actually, let's talk NASDAQ. What do you have any vibe on NASDAQ at this point, or is it sort of neutral as far as positioning goes?
Well, let me ask you this. You've been calling the top for a year and a half. Why? Based on what? What is it that was making you call the top?
You know why? This why I don't take myself seriously. Overvaluation.
It's an important point. It's an important point. So
yeah, overvaluation. This has got to stop. It's going. It's like what's that? I forget. We're like 25 earnings. Basically the usual fundamental excuses we give. The economy is going to slow down. Earnings are going to compress. The other one is interest rates are going to expand, so the PE ratio is going to compress. So that
macro fundamentals.
Yeah, macro fundamentals. Right.
So, as I would look at it, I feel like that's what the vast majority of people were thinking, for those same reasons. I just had a friend of mine who's a broker. He was my very first broker in my life, retail broker, when I was in Hong Kong. When I placed my first buy one Hang Seng Index futures contract trade, he was my broker.
Right.
30 years later, he's now an institutional broker doing, hedge funds and options and derivatives. And so, but I've talked to him, maybe not every day, but 2-3 times a week for 35 years. We grew up in the business together. We took similar views on how markets work and observations. He wrote a thing this week, and he has not been bearish this whole way, nor have I. He wrote a thing this week. What if all the pundits who missed the extended bull markets because the Fed was too loose and flooded the market with easy money, government deficit spending had to end badly, but all the while American consumers continue to spend, unemployment stayed at historical lows that perpetuated the U.S. markets to consistent all-time highs? What happens if now, with the Dow 43, S&P 6,000, they start to capitulate because a new business-friendly administration with control of the House and Senate start to get bullish as a new administration comes in, wants to shrink government, cut spending, and impose tariffs that they could be getting bullish right at the top. I feel like we are very close to that now, if not there, right? I have been waiting for this, right? Where was the bullish capitulation ever going to come? Because it was never coming. Everybody was bearish this whole freaking way up. They wouldn't capitulate. We have a possible capitulation here because of the Trump thing, right? When Trump was elected the first time, people didn't know what the hell it meant. The stock market was in a semi-crash overnight after the election. By the time we woke up, the stock market was flat on the night, and we never looked back. Okay? So this time, nobody was going to short Trump. They wanted to buy Trump, right? I have a client who I also consider a very good friend who has been bearish this whole time. He's a very, I'm not going to call him very right-wing, but he's a conservative guy. He's a Republican guy. He has hated the market for the last 2 years. I always believe because he hates Democrats and he hated Joe Biden and all that. He is now bullish for the first time in 2 years because the whole Trump thing, and he thinks that Trump is going to save the world. And I'm not saying that Trump's not going to, okay? I hope he does, quite frankly. But he believes in all this, and now he's gone bullish, right? We had one of my favorite fades come out, and this guy has been bearish forever, okay? And shorting everything from S&Ps to NVIDIA to everything for the last 2.5 years. He came out on Wednesday. Okay, on Wednesday, midway through the day, he does a video every day at 1 o'clock. At 1:11 p.m. on Wednesday, he said, for those of you who are trying to short, now is not a good time to be naked short anything. He said that on Wednesday. This guy has been short everything for 2.5 years. I'm telling you right now, my stuff is set up to short anyway. I need a market to confirm it before I'll do it. Right. I shorted some S&Ps on that statement. Okay, not a lot because that's being a wise ass, but by the time it closed, the market did confirm, so I was able to get short my real position size. But we're starting to see stuff like that. Does that mean we just hit the exact all-time high? No, but I think the odds have, without a doubt, changed here, right? I've heard consistently since the election, the biggest thing I've heard, and I don't want to rip too much on people, and I never mean this stuff as a rip. I am just trying to gauge what consensus is. People take it personally. I don't mean it personally. I've heard this now ever since the election, and we just heard it from your 3 previous guests, just by the way. And I happen to love I only know 2 of them. I think they're great, but they all said the same thing. Oh, I think the market can go down, but not until January.
Right. I hear
that every day now, every day from everyone, from all the people that have been bearish, from all the perma bears. That's what everybody says. The market cannot go down before year end because we get the Christmas rally, because years go down into year end. And that all might be true.
Oh my God.
Might be true, but to me, the risk reward here for the very first time in a long time to me is the other way. That's what I think. And it's just a trade, that A could be wrong. And B doesn't mean the market's about to crash. Doesn't mean that was the all-time high for the world. I mean, at the end of the day, shorting the stock market is the worst trade that you can ever do over time. It's the only market that you can point to that has upward drift over time, right? So shorting it is just horrible. It's horrible. I hate doing it. It's horrible. But in this particular case, I think the risk reward points to that right now. And
I went into this last week net long, and I came out net short.
Right.
Now, is it just purely algorithmically, just Tom, in terms of you kind of like
the longer term ones are still to the up direction, and the short term ones started kicking in really quick right around Wednesday, Thursday, definitely Friday. The Nikkei was down 1,500 or I don't know what it was. Yeah. It was down on Friday. It was way over 1,000 last I looked. I don't remember where the close was, but some of these indexes around the world are.
See, that's such an interesting thing, that the fact that you expose yourself, not just I'm as guilty of this as anybody else. I have such U.S. centric eyeballs, and even everybody who trades with me globally, pretty much these days only trades the U.S. indices. Like everybody trades the NASDAQ, whether you're in Kuala Lumpur or in Cambodia or in Karachi or in Maine. You're just trading NASDAQ, right? So it's hard. We don't see sometimes the weakness shows itself on the edges, and we don't see that because you're exposing yourself by trading all those markets and being much more aware of it, right?
Right. It also helps give me a sense of what's happening out in the world. What are other economies doing? How do we in the U.S. compared to, say, Europe, and how they're doing economically, and Britain with the Brexit, and it just gives me a little bit of a world sense of things just by glancing up and down my screens and seeing what markets are doing. Things like commodities are sometimes worldwide markets. Sugar's traded in a lot of places. Cocoa from Africa, copper. I trade iron ore in Singapore. There's a lot of different things going on, and you get a sense of some of the industrial metals and the precious metals and what the currency markets are doing and the debt markets are doing. And you get a sense of a lot of different aspects of a macroeconomic environment. But as Jason points out, and you pointed out earlier, I don't even trade my beliefs. I mean, I just have math, and to guard against anything, I just take that stop and I stick it in there, and it gets executed, whether I'm out trading, trimming the bushes or sitting here in front of the computer. It happens no matter which way. And, I find out about it at the end of the day when I sit down to do the afternoon process and get all my positions listed properly, make sure everything happened the way I wanted it to happen, and make any corrections that I have to make if an error has occurred of some sort. And it's pretty interesting to see that perspective of the whole world and what's going on. But I have to agree with Jason. It seems to me, right around Wednesday, it's looked like a lot of stock indices. I trade the IFO over in Europe. I trade the Nikkei. It just seemed like all of them were starting to look a little on the downside. And when you see, after such a long run and so many people finally getting, really patriotically bullish after the election. Some people almost, really, really punch drunk with how important the election was and all that. And it may, like Jason said, I hope Trump makes the whole world a better place. Why not? What human being wouldn't want that? It would be illogical, especially a guy like me in retirement. When he talks about the golden years for the U.S., hey, I'm in my golden years. I would like to think that the rest of my life could be spent in a wonderful place. But the reality is sometimes things are tough. Sometimes they're good, but you cannot. The market will do what the market will do. If the market's been up for so long and then everybody starts panicking all of a sudden, it's going to get very crowded. To use Jason's report, it's going to get crowded at the exit. There's going to be a lot of people panicking, and my studies would show that markets go down, stock markets go down, and particularly at maybe 2.5 to 3 times the speed that they go up. So it gets to be very fast and bloody, and it sneaks up on people, and man, it gets crowded at the exit door, and then you get a whole bunch of people swearing off the market. I'm never getting in the stock market again. I lost 50% of my money. Blah, 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 blah. It was my broker's fault, or my brother who told me to get into the market. He's an idiot. I'm never going to talk to him again. And then, then we're ready to start the process of going higher again. And Jason can call the next bull.
Yeah. So, I make a few comments. The idea that the market goes down so much quicker than it goes up, I think is why, despite the fact that the market goes up over time and it's obvious and there's upward drift, that's why people love to short so much, right? I call it the heroin effect. I think shorting the stock market is very much like being addicted to heroin, okay? Because it probably feels good. I've never taken heroin, although I have shorted the stock market a lot and lost money doing it. But, it feels good, but at the end of the day, it kills you, right? And ruins your life, for that matter. So I think that's why people love to short the stock market so much, because it does go down so much quicker than it goes up. And you feel like a hero. It's like the hero effect when you catch a short. But having said that, if in fact, and I don't know, if in fact the market is going to go down, right, it's still difficult, because the problem with bear markets, they're so hard to trade because they always have squeezes higher. So you got to be willing, if you're going to sit here short, you got to be willing to sit through some fantastical squeezes higher during it, because it's going to make it look like it's a bull market all over again. And you're going to go into the idea of, oh my God, every time I've shorted, this is what happens. I better get out. It's going to force you out of those shorts. Trading from the short side is so freaking hard. I don't think that people should really do it. If you're bearish, then, cut your longs if that's what you want to do, right? I think trading from the short side is so difficult. And not only is it a difficult trade, if God forbid you actually make money doing it, now you're screwed for life. Because now you are addicted to the heroin. And now but I've done that, and I know almost everybody I know has done that. Okay. Right. There's nothing better than the feeling of making money short the stock market. You're the hero. All your friends are sitting there at dinner crying because they're losing money with their investments. And you're like, oh, I'm a freaking hero, man. I killed it today, right? It's the most addicting thing there is. And it's the worst trade over time that there ever is. So as much as you make on this one particular short trade, there's a 99% chance you're going to lose it back over time anyway. So
okay, a little confession time, because what Jason is saying is just hitting too hard to the stone. But I'll say this: so I was raised during the '87 crash, right? Which there's a couple of interesting points about that. First of all, the '87 crash, which I survived, the Drexel Burnham live. To this day, the Kennedy assassination. You remember everything about that day. Had the greatest, to this day, still the greatest rally you've ever seen. Nobody ever talks about it, but from around 11 o'clock in the morning till about 2:30 p.m., we rallied something like 200 Dow points, which at that time was like a 10% move to the upside, before we died back down and just closed in a pure destructive moment. But the point was that did always instill in me the love of being short, which has been huge detriment. Had I just simply been an accountant and put all my money into an IRA ETF and never looked at it, I probably would have had a lot more in my IRA than me trying to screw around, trying to hit tops and bottoms. It's actually
if you put it in a NASDAQ IRA, you would definitely have more money.
Yeah, exactly, 100%. But it's really funny. You are very much formed by the experiences you have in the market. I think it's a really, really good point.
And in 08, it was the same thing. I can remember 08, okay, when things were crashing. We'd come in the morning, and the S&P was down, whatever, would gap down something, 2-3%. And by 10 o'clock, it was up on the day.
Right.
And by 4 o'clock, it was down 10%. You know what I mean?
Exactly.
But if you think that it was easy to wake up, you're short the S&P, it's down 3% when you wake up, and by 10 a.m. it's up on the day. You think it's easy to keep that short on?
No.
Okay.
No. 100%.
You're kidding yourself, man. Trading the short side is so freaking hard. Not only is time against you, but even when it's working, it's hard.
Right. And I will add one other thing that, Jason, you were saying the reason why people get so attracted to it because of 2.5 time decline that Tom was talking about, but it's also the reason why almost nobody makes the money on the long side. When they did the studies of regular retail traders, their average return, even though they were long only traders, were like 5.5%. They basically lost fully 5% because everybody gets scared when the market sells off and they basically sell at the bottom. They have to, buy back in and rebuild their equity. So,
I mean, I had a woman hit me up just about at the lows in 2000. What was it down here? 2022. Just about at the lows. It was somewhere around within 3 or 4% of the lows. She was this woman that I was friends with, who was actually the wife of a guy who played in a band I played in. Right. I hadn't talked to her in, I don't know, 3 years, because I haven't been in that band since I moved up to Rhode Island. I hadn't talked to her in 3 years. She just all of a sudden calls me up, and she's like, "Oh my God, what the hell am I going to do? All my retirement money, I'm sick of this. I'm sick of losing all my retirement money. I'm getting out of all my investments in the stock market and all this stuff. What should I put my money in? I'm thinking about putting it in the BlackRock real estate fund," which everybody at that time was buying because it was up that year, right?
Right. Yeah.
And I was like, "Listen, honey, you do what you got to do, okay? But I'm just telling you, now's not the time." And that was right there at the bottom. Like they say they don't ring a bell, okay, at the top and bottoms, but the truth is they do ring a bell at the top.
Yeah.
Jason, I was in a dentist appointment, and I was just getting my teeth cleaned that day. And the dentist, who normally doesn't see me when they're cleaning my teeth, comes in at the end of my appointment, distraught over her broker account and the pension for the whole dental office with everybody's got shredded. And they were losing money hand over fist and all that. What do I do, Tom? Because didn't you do something in the money management stuff way back when? I seem to remember you do something like that. And yeah. And I look at it. It's no plan, no risk control, no nothing. And what? Yeah.
It's almost malpractice. Yeah, I know.
I mean, if you want the idea,
it's already out. You might as well close the door. It's like, I don't know what to tell you.
If you've bought into the idea that you should be putting your retirement money into the stock market over time and dollar cost averaging over time, if you bought into that idea, then clearly you must have seen that there are times when you have 20, 30, even 40% moves against you. Like one goes with the other, right?
Exactly.
But for some reason, it's like you say, that's all great in theory, but
But actually, the theory is awesome. Like if you actually follow that plan is the greatest plan of all. You don't even have to do any fancy, 8 strategies, mean reversion that Tom is doing. Yeah. If you just literally, this has been buy to dip for the last 30 years. If nobody does that though, nobody's able to
130 years.
It's all about, trading to me is like Jason said, it's one of the most difficult things you can do, but a lot of it's because of the mental side. If you can't stabilize your brain and understand the good and bad, I do it more with math and statistics and computers. Jason does it by sensing, switches and getting little tips from ladies that call him in the middle of the night or whatever. But whatever the technique is, it's kind of still comes down to your own mental capability of knowing yourself, knowing the risk you're taking on, knowing the potential reward that awaits you if you do it properly. And if you don't have your head screwed on straight, the markets will just rip you apart. Find every weakness.
That is what makes it hard. I mean, trying to figure out a process that makes money over time. Okay, that's hard, right? But that can be done. You know, I actually don't believe it doesn't even matter what your process is. What matters is, are you disciplined? Can you handle this cycle? The psychological part is the part that makes it so incredibly difficult. Exactly. And I would argue with one thing that you said: if you don't have your head screwed on straight, I think if you have your head screwed on straight, you're going to fail, because the market is illogical relative to other things that you see in life, right? You actually have to have your head not screwed on straight. Okay. And I thrive on it. People tell me all the time, "You're a freaking lunatic." My wife or family, you know what I mean? They laugh at me. Everybody's always laughing at me. You know, I make jokes. You know, to me, it's all just for fun. But like, you know, you're freaking crazy. I'm like,
my wife has every now and again says, "You don't want to be in Tom's head."
No, that's right. And that's how you have to be in this game. And most people fail at this game. And that's because most people are normal by definition, right? If you're normal and you think normally, this isn't going to work for you. The market is not normal because it's a discounting process, right? Yeah. It's not like everything else, you know. You can make a prediction about the future. Donald Trump's going to win the presidency and be right. But that's not the point, right? The point is what's discounted in, right? And the market is a discounting process. So your ability to say what I hear guys say it all the time. The guys that were bearish. Oh, we were right about everything what we said.
Right.
We just got the price of the asset wrong. Okay. Well, that's the only thing that matters, dude. Like, I don't care how many of the macro calls you got right. Oh, you said retail sales was going to drop. You said employment was going to go up. Well, whatever you said. But you got the price of the asset wrong. That's what we trade. We're not trading futures on GDP, right? We're trading futures on S&P or whatever. Like, that's what you have to get right. But that's how people justify it. Oh, everything we said was right except for our forecast on price. Okay, good.
Except the actual trade that matters, right? That's absolutely true. That was the classic Jane Street trade. We you know, Sam Bankman-Fried, who went to jail. Before that was a proprietary trader. They had figured out the Trump trade in 2016, way ahead of everybody, made the bet. And unfortunately, they just made the bet on the wrong. They made a bet on the S&P, and the whole thing was like, yeah, we had the result figured out right, but the trade wrong, which is exactly what you're talking about.
Right. I'd rather have the result wrong, and I'd rather have the idea wrong and the trade right. I mean, like I say it all the time: be wrong, make money. And the market, if you just listen to the market instead of listening to yourself, that will help you do that, right? Hey, I think everything's going to go straight down. You know what? It just closed at new all-time highs. Okay, well, then I'm going to get long. You know, be wrong, make money, right?
Exactly. Gentlemen, I pushed everybody well above limits, so I definitely taken advantage of your time. I want to thank you again. You have been troopers, and thank you again for coming back. We've had over 3,000 people here. They're just hanging on your every word. They're telling me this was one of the best contests they've seen on YouTube. We're definitely going to cut this. We're going to give it to everybody. You guys are we're certainly going to share everything with everybody. Everybody go to Crowded Market Report, Jason. Everybody follow him. Amazing Twitter feed. Really, I'm telling you. He's been prophetic, and I would be shocked. Now I'm not going to jinx you. I'm not going to say a word. I don't want to jinx you because, you know, he's always going to. So he's great. Just go follow him. He's got great ideas. Tom has a beautiful website called
enjoytheride.world.
Right. Enjoytheride.world, which is a great
website.
We'll be sending with all the positivity over there.
Right. We'll be sending you guys the link to all of that in the post event. So thank you, gentlemen, very, very much. All the best to you. Enjoy your Saturday. I have tortured you long enough, but you've really provided us some amazing stuff. I want to thank you again for being such great participants.